Hey everyone, and welcome back to the channel. Today, we're embarking on a journey to build your financial future. Investing. Whether you're a total newcomer or simply want to brush up on the basics, this video will equip you with essential knowledge. We'll be unpacking what investing is all about and explore strategies to make your money work for you. Remember, the world of investing can be intricate, so staying tuned until the end is key. We'll break down some crucial concepts and equip you with the tools to make informed decisions as you navigate your financial path. Let's begin. What is investing? In essence, investing is the act of using your money to acquire something that has the potential to generate returns over time. These somethings can be diverse, ranging from company shares, stocks, and government bonds to real estate or even starting your own business. The underlying principle is to put your money to work, aiming to grow it at a faster rate than inflation, which gradually erodes its purchasing power. Let's say you save $1,000 today. If inflation is at 2% annually, in 10 years, that same $1,000 will buy less because the cost of goods and services will have increased. Conversely, if you invest that $1,000 wisely and it grows at a rate exceeding 2%, you'll not only maintain its purchasing power but also potentially increase its value. Types of investing. The investing landscape offers a variety of avenues, each with its own risk profile. Here's a glimpse into some of the most common ones. Stocks. When you purchase a stock, you're essentially buying a piece of ownership in a company. The hope is that the company's value will increase over time, leading to a rise in your stock price. Additionally, some companies distribute a portion of their profits to shareholders in the form of dividends, providing you with a regular income stream. Bonds. With bonds, you're essentially loaning money to a government or corporation. In return, they promise to pay you interest over a set period and then return your original investment at the bond's maturity date. Bonds are generally considered less risky than stocks as they offer a fixed income and have a lower chance of losing value entirely. However, they typically come with lower potential returns compared to stocks. Mutual funds. Imagine a pool of money contributed by various investors. A mutual fund is a professionally managed investment vehicle that uses this pooled money to purchase a diversified portfolio of assets like stocks, bonds, or a combination of both. This allows investors to gain exposure to a variety of markets with a single investment, reducing risk compared to putting all your money in one stock. Exchange-traded funds, ETFs similar to mutual funds. ETFs are baskets of securities that trade on stock exchanges throughout the day, just like individual stocks. They offer diversification and often come with lower fees compared to actively managed mutual funds. Real estate. Investing in real estate can involve purchasing property for rental income or hoping for appreciation in its value over time. This can be a great way to build wealth, but it also comes with its own set of considerations, such as management responsibilities and potential for vacancy periods. Commodities. Commodities are agricultural products, energy products, and metals, including precious metals. These assets are generally the raw materials used by industry, and their prices depend on market demand. For example, if a flood impacts the supply of wheat, the price of wheat might increase due to scarcity. Buying physical commodities means holding quantities of oil, wheat, and gold. As you might imagine, this is not how most people invest in commodities. Instead, investors buy commodities using futures and options contracts. You can also invest in commodities via other securities, like ETFs or buying the shares of companies that produce commodities. Commodities can be relatively high-risk investments. Futures and options investing frequently involves trading with money you borrow, amplifying your potential for losses. That's why buying commodities is typically for more experienced investors. Risk and return. An essential concept in investing is the inherent relationship between risk and return. Generally, investments with the potential for higher returns come with a greater risk of losing money. For instance, stocks have the potential for significant growth, but they also carry the risk of a company's value declining, leading to losses for shareholders. Conversely, bonds offer a more stable and predictable return, but their potential for growth is typically lower. Understanding your risk tolerance is crucial before venturing into the investing world. Are you comfortable with the possibility of short-term short-term losses in exchange for the potential for higher long-term gains? Risk tolerance is a personal assessment that will influence your investment choices. Diversification, spreading your wings to reduce risk. Imagine a tightrope walker with a net position safely below. That net represents diversification, a cornerstone principle in investing. It's the art of spreading your investments across different asset classes, such as stocks, bonds, real estate, and even commodities. Why is this so important? Because by diversifying, you're essentially creating a safety net for your portfolio. Here's the logic: markets and asset classes can be unpredictable. While a downturn in one sector might cause the value of your investments there to decline, others might experience growth. Diversification helps to mitigate this risk. If you've invested solely in tech stocks and the tech industry experiences a slump, your entire portfolio would suffer. However, by diversifying across different sectors like technology, healthcare, and consumer staples, you create a buffer. A downturn in one sector might affect you, but it's less likely to cause a significant overall loss. Think of it like building a house. You wouldn't use only one type of material for the entire structure, right? You'd use a combination of wood, concrete, and other materials to create a strong and stable foundation. Similarly, a diversified portfolio acts as a strong foundation for your financial future. Time horizon, investing with the future in mind. The ideal investment strategy for you depends not only on your risk tolerance, but also on your time horizon. This refers to the amount of time you plan to hold onto your investments before needing the money. Here's how your time horizon can influence your investment decisions. Short-term goals. 1 to 3 years. Are you saving for a down payment on a car, a dream vacation, or a wedding? If your goals are within the next few years, you might prioritize lower-risk investments with easier access to your money. Savings accounts, certificates of deposit, CDs, or short-term bond funds could be suitable options. These offer lower potential returns, but they also come with lower risk and ensure you have your money readily available when you need it. Midterm goals. 3 to 7 years. Perhaps you're saving for a child's college education or a major home renovation. These goals fall into the midterm range. You can incorporate a slightly higher risk tolerance with a mix of investments. Consider a combination of bonds and stocks with a focus on stability and moderate growth potential. While there's a chance of experiencing some short-term fluctuations in the market, you have a longer time horizon to ride out these ups and downs and potentially achieve your goals. Long-term goals, 10+ years retirement savings or building wealth for the distant future are considered long-term goals. With a longer time horizon, you can take on more risk for potentially higher returns. A portfolio that leans towards stocks, potentially including growth stocks with the potential for significant long-term appreciation, could be a good fit. Remember, time is a powerful ally in the investment world. The longer you invest, the more time your money has to grow through compounding interest. Compound interest is essentially earning interest on your interest, allowing your investment to snowball over time. Financial goals, charting your course to success. Before diving headfirst into investing, take a moment to define your financial goals. What are you investing for? Is it a comfortable retirement, a dream vacation home, or funding your children's education? Having clear goals in mind is crucial for several reasons. First, it helps you choose the right investment vehicles. For instance, if your goal is retirement, you'll likely prioritize long-term growth and income-generating investments. Second, clear goals allow you to track your progress. By having a specific target in mind, you can monitor your investments and see how you're progressing towards achieving your financial dreams. Remember, investing is a marathon, not a sprint. By understanding these core concepts and incorporating diversification, time horizon, and financial goals into your strategy, you're well on your way to making informed decisions and building a secure financial future. Start investing early, keep investing regularly. Successful investors typically build wealth systematically through regular investments, such as payroll deductions at work or automatic deductions from a checking or savings account, says Jess Emery, a spokesperson for Vanguard Funds. Regularly investing helps you take advantage of natural market fluctuations. When you invest a consistent amount over time, you buy fewer shares when prices are high and more shares when prices are low. Over time, this may help you pay less on average per share, a principle known as dollar cost averaging. Good investing begins by investing in yourself. Learn about the types of retirement accounts. Get your emergency savings squared away. today. Create a strategy for paying down your student loan debt. And with those key financial tools in action, you can start investing with confidence, putting the money you have today to work securing your future. That's it for today. Investing can be a powerful tool to secure your financial future. But remember, this video is just a starting point. Do your research, consult with a financial advisor if needed, and most importantly, be patient and disciplined. With the right knowledge and strategy, you can take control of your finances and unlock your path to financial freedom. Thanks for watching. Like this video and subscribe to the channel for more finance tips and tricks. See you next time.